Hi there. We're going to do another tutorial on dividend policy. And in this one, I want to add the effects of taxes. In the textbook, Benninga talks about how dividends are taxed as ordinary income and capital gains are taxed at a lower, more favorable rate. But since that's been published, some things have changed. For instance, now dividends and capital gains are both taxed at the same rate. And depending on the level of income that you make, or the amount of income you make, you will have a different capital gains and dividend tax rate. So for instance, if you're a single person making between $90,000 and $189,000 per year, your marginal tax rate on ordinary income, wage income, etc., is 28%. However, your tax rate on dividends and long-term capital gains is 15%. So it's not the same as it was at the time the book was published. When the book was published, those were taxed, dividends would have been taxed at 28% for someone in this tax bracket, while capital gains would have been taxed at 15%. However, now it's the same. So with the tax code changing, the favorability of dividends versus capital gains has changed. So if this is the spreadsheet that we're looking at, we're going to take a look basically at section 9.2 in the book, where we realize that if you have to pay taxes, the payment of dividends matters, right? In our previous slide, we showed, well, with no taxes, in terms of getting money to the owners in the lowest tax situation, right? If there's no taxes, it doesn't matter. But let's take a look at a different situation where Lauren, again, is looking at paying herself a dividend, and Jeff, again, is not. And then let's compare the results of these two individuals' payment strategies under taxes. So Jeff and Lauren both own pizza companies, and Jeff did not pay himself a dividend. Lauren, on the other hand, paid herself a dividend. And this is the balance sheet of both companies after the dividend and after not the dividend. Both of these companies are identical. They're pizza companies. They have identical free cash flows. Both the present value have present value of their future free cash flows at $100,000. But we can see what the dividend did, right? It reduced the cash balance by $5,000, and it reduced the balance of retained earnings, right, for Lauren by $5,000. So the value of assets and total liabilities and equities for Lauren's company is $5,000 less than that of Jeff's company. So she's paid herself $5,000, and now let's see what happens to that $5,000 and the value of the company when there are taxes. So like we did in the previous tutorial, we're going to figure out how much cash Jeff would get if he sold his company for the enterprise value of $100,000. He's going to receive the $100,000 in cash, $100,000 for the enterprise, plus the $10,000 for cash, and he's going to have to pay the $25,000 he owes in debt, right? This is what the text refers to as paying off net debt, but I'm trying to do it in a way that matches what we did in chapter 7. So he's going to receive $85,000 before taxes. How much tax he needs to pay depends on, 1, the tax rate, but 2, the book value of equity. So his book value of equity is the $15,000 in common stock, what he paid to start the firm, plus the $35,000 in retained earnings. That means his taxable gain is going to be the difference between these two, otherwise known as $35,000. Now, if he were selling this, this $35,000 would be subject to capital gains. So I'm going to call it a negative 15% times the taxable gain, meaning he's going to need to pay $5,250 in taxes. And that tells us that of the $85,000 in cash he'll receive from the sale of the firm, he'll have to spend $5,250 on income taxes, which tells us he's going to receive $79,750. He doesn't take dividends, So he doesn't pay tax on those dividends. So his total cash that he would receive would be $79,750. So let's take a look at Lauren's. Let's see what total cash to owner she's going to receive were she to take a dividend before selling the company, right? This is kind of like asking ourselves, all right, I want to sell the company, but I want to take the cash out in the form of a dividend first. So her cash to owner would be the $10,000 in sale price plus the $5,000 from cash minus the $25,000 in debt. Right? You can see here that her cash to owner is a little bit less because she's taken the cash out of the firm, right? They're not going to, Jeff's going to get $5,000 more because there's $5,000 in cash that Lauren took off so she could go to Fiji. The book value of equity in Lauren's case is a little bit less too because she paid her dividends essentially out of cash, but also out of retained earnings. So her taxable gain is going to be the same. Her taxes on her gain, also 15% multiplied by that taxable gain, which means that from the sale of her firm, oops, did you catch what I did? I screwed up. She's going to receive $80,000, and she'll pay $5,200 of that in tax, meaning that she's going to receive from the sale $74,750, right? Less than what Jeff's going to receive. Why? Because she's taken the $5,000 out and she's paid it, right? So she'll receive that from the sale of the firm, and she'll receive some money from the payment of a dividend. She took $5,000 as a dividend. However, she's going to have to pay 15% tax on that $5,000 dividend. So her total cash to her as an owner is going to be the $74,000 that she gets from selling the firm, plus the $5,000 that she gets from the dividend, minus the $750 she's going to have to pay for the dividend. And this is interesting because even though dividends and capital gains are taxed at the same rate, paying yourself a dividend means that you are going to have to pay tax on that dividend separate from the tax that that firm already paid in order to add that cash to their balance sheet. So the difference here, that $750, is the result of double taxation, right? The firm pays tax on that cash, right? And then you pay tax again. So when there's tax, at least at these tax rates, right, you can pull more money out of your firm by not taking the dividend, right? And again, it's going to just depend on tax policy, right? And so I'm not telling you what is better or worse. I'm just showing you how to analyze it given tax rates. So when you're 45 and you're trying to pull money out of your own business and the tax policy is totally different, you'll be able to run the same sort of analysis using different tax rates to see what would be the most profitable or the most lucrative for you as a business owner.